Hello everyone. In the last video we just explained that there are three different methods for depreciation of fixed assets. In this video I'm going to explain a little bit more in details the three methods and how they are performed and how we can do the calculations. So one of the easiest methods is what we call the straight line method. In the straight line method it provides for the same amount of depreciation expense for each year of the asset's useful life. So once we decide on a value, it's going to be exactly the same from a year to another. So the annual straight line depreciation, let's say for Exter forklift, is $4,400. And how is this computed? We simply get the cost, the original cost that we incurred for the asset. Then we subtract the residual value or the scrap value or the salvage value, and then we divided it by the expected useful life. Usually the expected useful life can be either in years, or if we want to be more specific we can go month by month. So in this case it's given to us in years, so we're going to use the 5 years because we're only going to calculate the annual depreciation rate as it's explained here. So we take the 24,000, which is the original cost of the asset, and then the 2,000 we subtract that because that's the residual value, and divide it by 5 years. So that's going to be 22,000 divided by 5, and that's equal to $4,400. So as you can see here, the $22,000, which is the depreciable cost, and I hope you remember the depreciable cost is the initial cost minus the residual value. The $22,000 were allocated over the 4 years equally, and each year we're going to record depreciation expense in our adjusting entry for $4,400. If we want to convert the 5 years into a percentage, because sometimes in the straight line method, instead of giving you the number of years, they tell you the depreciation rate or depreciation straight line rate is 20%. So you just take 5, and that would be the number of years, and so you take 1 over 5, and that would be 20%. So we'll see that in the next slide here. So computing straight line depreciation may be simplified by converting the annual depreciation to a percentage of depreciable cost. So the straight line percentage is determined by dividing 100% by the number of years expected, or number of years of expected useful life. So for example, if it's 5 years, we take 100 divided by 5, or simply 1 over 5, and that's equal to 20%. So I think it's easier to do the 100%. So 100% divided by 5, that's 20%. We can also, for 8 years, we take 100% divided by 8, and that's 12.5%. And we multiply this percentage by the depreciable cost. In our case, it was $22,000. So for the 10 years, again, 100% divided by 10, and that's going to be 10%. For 20 years, again, 100 divided by 20, and that's 5%. 25 years, which is maybe for very long-term assets, we take 100% divided by 25 years, and that's 4% per year. So how would the adjusting journal entry would look like under the straight line method? And by the way, the journal entry is the same, or the adjusting entry is the same. It's not going to be different from one method to another. The values would be different. So depreciation of the forklift for the first year using the straight line method would be on December 31st, and remember that's the date where we do the adjusting entries. Depreciation expense would be debited, which is an expense that would have a negative impact on the stockholders' equity, and it's debited. And then we credit accumulated depreciation. We never credit the asset itself. We use this contra asset account, which would be reported in the balance sheet in a negative value. So the 4,400 here is the value that we calculated, and it's going to be exactly the same journal or adjusting entry every year for the coming 5 years. So we debit depreciation expense, credit accumulated depreciation. Pretty standard. Adjusting entry doesn't change. The only thing that will change are the values. So accumulated depreciation accounts are called, again, contra asset accounts, or contra accounts to simplify, but to be more specific, it's a contra asset account because it belongs to the asset side. It's on the balance sheet, but it's with a negative value. It's an opposite nature, so it has a credit nature. You know, all assets, they have a debit nature, but since this is a contra, then it's going to have a credit nature. So this is because accumulated depreciation accounts are deducted from their related fixed assets accounts on the balance sheet. The difference between the fixed asset account and its related accumulated depreciation account is called the asset's book value. Sometimes I personally like to call it net book value of the asset. Okay, the word net reminds me that we're deducting the accumulated depreciation from the asset's value. So let's see like this diagram that shows how the depreciation would look like and how the book value of the asset would look like. So you can see here the depreciation year by year using the straight line method. It's fixed. It's going to be 4,400 year after year, and the value of the asset would keep going down from the original 2,400 to 19,600, 15,200, and you can see here it's a steady decline in the value of the asset until it reaches the residual value at year 5, which is the $2,000. Now let's see another method, which is called the units of activity method, and this is a method that is based on the amount of usage or the amount of activity use of the asset. So the units of activity method provides the same amount of depreciation expense for each unit of activity of the asset. But year after year, I think, unless your usage is stable, the depreciation expense would vary. So depending on the asset, the unit of activity can be expressed in terms of hours, miles driven, if it's like truck or a car or something like that, or quantity produced. Like think about a photocopier machine. The more copies it makes, then it produces more, so it's going to depreciate more or depreciate faster. So for manufacturing assets, the units of activity are often expressed as units of product. So factories that relies on machinery, I think the units of activity would be the best approach to record depreciation for the machinery. So in this case, the units of activity method may be called the units of production method, or sometimes they call it the units of output method. So again, these are different terms. Don't get confused if you see these different expressions, because they all have the same meaning, and when we apply them, they're basically the same. So the units of activity method is applied in the following 2 steps. We have to go through these 2 steps. The first step is to determine the depreciation per unit. And it's not too difficult because it's very similar to the straight line approach. So the depreciation per unit is calculated as the cost minus the residual value divided by the total estimated unit of activity. And that would give us the depreciation per unit. That's not the number to be used. That's going to be applied in the second step to compute the depreciation expense, and it's calculated as depreciation per unit multiplied by the units of activity for the period. So again, in this approach, we have to make an estimate for how productive this asset would be. So for example, a truck, we expect it to be driven for 100,000 miles. So our total estimated units of activity would be 100,000 miles. And then we see how long or how many miles it was used during this period, and that's going to be used here, the units of activity for the period. So let's say in the first year we used it for 20,000 miles. We take the 20,000 miles and multiply it by the depreciation per unit that was calculated in the first step. So actually this should have been under step 2. This line here should move down. So let's see an example based on the same example that we have. Depreciation for the first year using the units of activity method would be calculated as follows. So let's see how this would be presented in the journal entry or the adjusting entry. The adjusting entry would be exactly the same. The depreciation expense on the debit side and accumulated depreciation on the credit side. But of course, the values are going to be different. Why they're different? Again, because the calculation would be slightly different from the straight line method. And by the way, it's not going to be stable from year to year unless we have the exact same usage from year to year. So let's see here. Again, we have the initial cost, we subtract the residual value, we get the depreciable cost, which is 22,000. And then you can see that the activity level from year to year has been different, like 2,100 hours in the first year, 1,500 in the second year, and so on. So it's not like stable or consistent kind of usage. So because of this, we have to see how much we are going to, or we estimate this forklift to be used, and then we calculate the depreciation per unit or per hour, and then for each year we multiply the depreciation per hour by the number of hours it used. So as you can see here, the depreciation expense per year has been all over the place. It's been up, down, depending on the number of hours the forklift has been used. And of course, the book value would keep going down, but it's not like perfectly straight line. Again, it depends on how much it declined based on the amount of depreciation per year. The last method, which is the double declining balance method, it's another approach. We have to look at it from a different perspective because we have to ignore the residual value. This is the key thing about the double declining balance method, and I want you to remember that. It's very important that we remember that we ignore the residual value. So the double declining balance method provides for a declining periodic expense over the expected useful life of the asset. The double declining balance method is applied in the following 3 steps. We determine the straight line percentage. Remember, it's not too hard. We get, if it's 5 years, we just get 1 over 5, which is 20%, or simply 100% divided by 5, which is 20%. And that's the first step. The second step, we get this rate and we'll multiply it by 2. And it's always by 2. And that's why it's called double declining. The word double is the reference for 2. And just as a reference, this is one of the most common mistakes that students do. They forget to multiply by 2. So don't forget to multiply by 2. Always remember, from the name, it's double declining. So we need to determine the double declining balance rate by multiplying the straight line rate by 2. The third step, we compute the depreciation expense by multiplying the double declining balance rate by the book value of the asset. And the book value in the very first year is its cost. So we don't subtract the residual value. We work with the original cost. And then in the second year, we subtract the accumulated depreciation to get the net book value and then multiply it again by the same double declining rate. So again, the journal entry would look exactly the same. You see here we have depreciation expense, accumulated depreciation, but of course the values would be different. The thing about the double declining balance method, it's one of those methods that are referred to as accelerated methods. Why they call it that way? Because the amount of depreciation in the early years is usually much higher compared to the later years. So let's see how this is done. So at the beginning of the first year, the book value of the equipment is its initial cost of $24,000. After the first year, the book value declined and therefore the depreciation also declines. The double declining balance depreciation for the full 5 years would look as follows. And remember, for the double declining method, it's much easier whenever we create a table. So remember, we had 5 years. So if we convert 5 years into a percentage, that's 20%, multiplied by 2, and that would be 40%. So the double declining rate that's going to be used for all years is the 40%. And I'll tell you why we didn't use the rate in the last year. So we start with a cost, which is the beginning book value, multiplied by 40%, and the amount of depreciation is $9,600. We subtract 9,600 from the 24,000, and that would give us 14,400. So now we have a cost of 24,000 in this next year. Our accumulated depreciation is the value of the depreciation for the previous year, for year 1, and that will give us a book value or net book value of 14,400, which is the difference between the 24 and the 9,600. We take this new book value for the second year to calculate the depreciation. We take this value, the 14,400, multiplied by 40%, and that would be 5,760. So you can see that the amount of depreciation declined from first year to second year. So the new book value now, we take the previous book value, which is 14,400, we subtract from it 5,760, and now the new book value is 8,640. To confirm, we can see that our cost for the third year is 24. Still, it's the same. It's never going to change, by the way. So the cost is the same. We subtract from it its accumulated depreciation. And how did we get this? It's the previous accumulated depreciation plus what we had for depreciation expense in year 2 would give us the accumulated depreciation for year 3. We subtract that from the 24,000 will give us the net book value, which is 8,640, which is, by the way, the same for last year. We take this value, multiply by 40%, and that would give us the new depreciation expense. And it keeps going down. That's why they call it accelerated method. So it's very fast in the very beginning, or the amount of depreciation is very high at the very beginning, it keeps declining. So 3456 is our depreciation expense for year 3. We subtracted from the book value of last year, and now we have a new book value of 5184. So how we present that in year 4? Again, the cost is the same, 24 minus 18,816, and 18,816, how did we get this? It's the previous accumulated depreciation plus the amount of depreciation expense from year 3. That would give us a new accumulated depreciation. The term accumulated, it keeps accumulating, it keeps getting bigger. So it's 18,816 subtracted, we subtracted that from 24,000, and we get the book value for year 4 to be 5184. Again, it's the same as the end of year 3. Multiply by 40%, and that would be 2,073. Subtract 20,073 from the book value, either here or there, that would give us 3110, 40 cents. For the last year, we cannot use the 40% because if we use the 40%, the value or the book value of the asset is going to go below its residual value. So how can we manage that? To manage that, we are going to plug in a value for the depreciation expense in the last year that would make the book value at year 5, at the end of year 5, exactly equal to the residual value. So we want it to be $2,000 in year 5. So we put the $2,000, subtract the difference between the book value in year 5 and year 4, which is about 1,110, 40 cents, and that would be our depreciation expense. So in this case, again, in year 5, we didn't use the formula. However, we all know the cost is still the same, 24,000. The accumulated depreciation at the beginning of the year is 20,889, which is the 18,816 plus the 2,073, and that would give us a book value at the beginning of the year of 3110, 40 cents. Again, we cannot multiply by 40%, and you can try it. Multiply it by 40%, it will give you a number that's much bigger than this, which would reduce the book value at the end of the year to a value below $2,000. This is not what we want. We want it to be $2,000. So we force it to be $2,000 in year 5, and we get the difference, and that's going to be the depreciation for year 5. So remember, year 5 is usually like slightly different. So when the double declining balance method is used, the estimated residual value is not considered. Okay, and remember that. That's the key thing. We consider it only in the last year to force it to be $2,000. The asset should not be depreciated below its estimated residual value, and that's why in the last year was different. The accelerated depreciation method provides for a higher depreciation amount in the first year of the asset's use, followed by a gradually declining amount of depreciation. So remember these things, it's very important. So as you can see here, we have the 22,000 depreciable cost, but we didn't use that, we used the 24,000. And that's the 40% rate that we used here, the double declining balance rate. The amount of depreciation expense kept declining, and it has to be this kind of steady decline. And then in the last year, we force it to be 1,110, which was the difference between the amount of net book value and the amount of the residual value. Again, on this graph here, you can see that the depreciation expense was very high in the very first year, and then it gets lower and lower and lower year by year. And again, if you look at the net book value, it's not straight line. It went down significantly at the very beginning, and then it keeps going down, of course, but with a slower rate. So a summary of depreciation methods here, you can see that the straight line, we have the units of activity and the double declining balance. The useful life is usually by year, except for the unit of activity, it's by the units of activity. The depreciable cost is cost less residual value for the straight line and the units of activity, but for the double declining balance method, it's declining book value, but not below residual value. And this is the formula for the depreciation rate, and then the depreciation expense for the straight line is constant. For the units of activity, it's variable. For the double declining balance method, it's declining. One last comparison here, it's that all three depreciation methods allocate a portion of the total cost of an asset to an accounting period, while never depreciating an asset below its residual value. So the straight line method provides for the same periodic amounts of depreciation expense over the life of the asset. The units of activity method provides for periodic amounts of depreciation expense that vary depending on the amounts or the amount the asset is used. And the double declining balance method provides for a higher depreciation amount in the first year of the asset use, followed by declining amounts. Let me stop here. In the next video we're going to see how the partial year depreciation can work. Thank you.